This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Greetings, and thank you so much for joining us. It's Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I am very, very fortunate to be joined by our macro advisor contributors, Craig Shapiro, who is actually our Edge manager, and Geoffrey, who has been working with us for a few months, but then has really kind of elevated a whole bunch of offerings through his company as well, Graph Financial. So greetings, gentlemen, and I don't know, a happy market bullish out of its mind. We're going to talk about that. Yeah, it's nice to be all here together because I know that you are contributing your model kind of with clients. For those who are unfamiliar, the Edge offering is much more kind of bespoke for those who kind of do it yourself, hedge fund managers and money managers. So the focus on macro is prominent. I run a live trading room, and there are lots of intermediate level active investors and traders that are very interested in kind of market timing calls and of course actionable trades. But to really drill into the backdrop of this market advance, to kind of really understand the direction, the duration of it, the intensity and the risk factors, this is the best, as far as I'm concerned, is using macro as a backdrop. So what I wanted to do with this get together was very much kind of model what we are seeing right now with this market. I have put together kind of my top 10 reasons that I see it's got some bullish legs, and then the risk factors that are coming up. So that was it in a nutshell. And then we'll kind of dig into some of the recent data of around inflation. I know Craig is very focused on not just sticky inflation, but a turn in higher inflation and the reasons for that. And Geoffrey has been fabulous in framing this kind of fiscal dominance backdrop that he knows very well about. Both of them focus on bonds and fixed income, precious metals, and all the other asset classes that either serve as proxies, Bitcoin and the rest, but we're not focusing on Bitcoin this time. We're gonna hit this one in 2 weeks. We're gonna have a full-on Bitcoin debate, the pros and cons. But for this particular, we'll call it session or episode, I want to focus more on the bond market's fears that inflation is entrenched and picking back up again. So with that, I'm going to first hand it over to Craig, kind of give us your market views, especially as it relates to inflation and what bonds do next.
Yeah. I mean, look, I think the thing that is perfect to have Geoffrey on today to talk about fiscal dominance in the government. But I think the biggest thing that folks, including myself, but I think most market prognosticators missed about 2023 and really about the strength in the overall U.S. economy has been the deficit spending and the role of government and the fiscal deficits and how supportive to growth, running 6 to 8% deficits has been. And I think that has been the main driver of why the data in the U.S. Continues to outperform. And I think, the question really, as we kind of transition into 2024 is, as that continues, and as that, let's say, even as the rate of change slows, does it slow rapidly enough in order to stomp out inflation with a Fed that is more focused on this real rate normalization cuts as opposed to the easing of financial conditions that we had? And I think what we're seeing now is, and I've been talking about this, is that to me, it looks like inflation momentum has bottomed already. For this cycle, maybe in October or in early November. A lot of the data that's been coming out, whether it's on core services, ex-housing inflation, that super core number we saw earlier this week was just a massive reacceleration. The Atlanta sticky CPI and the Fed stick, the Cleveland Fed and just a variety of prices paid on services ISM was the biggest jump we've seen in a long time. And then today, Philly Fed and Empire Fed both showed rapid acceleration of prices paid indicators. So, and this has all been done really without crude, rapidly moving higher, but it looks like crude is even kind of ready to go again. So I think what we have is a Fed that, allowed financial conditions to loosen so dramatically while the government was spending or continues to spend so dramatically, such that this idea that the last mile of inflation was going to be achieved in 2024, I think is starting to get questioned very significantly, or will continue to be questioned. And I think that the real question for risk and for markets, and I think as it turns out, we have a huge data point tomorrow in PPI, because PPI provides color for the core PCE number that comes out in 2 weeks. But I think at this point, the Fed needs to either come out and be more explicitly hawkish and price out the rate cuts that it allowed to get put into the market psyche. It needs to either do that with hopefully a hot PPI print tomorrow that firmly takes March off the table and probably takes May off the table in order to bring inflation back down. Because if they don't, what we're going to have is a continuation of this blow off for the next, for the next 4 weeks, until we really get a weakening of the dollar, a likely sell off in the back end, crude going up another $10, and then inflation expectations will be ripping higher and probably get into a situation where the Fed, really can't even cut at all this year. So I think there's an opportunity here. I would expect the Fed, if the number tomorrow kind of confirms that core PCE is it moving lower, I would expect the speakers that come out in the next couple of days, plus Powell speaks the first week of March now to Congress, I would expect them to push back, because if they don't, we'll have a blow off, right? This is a blow off. But it won't stop until the Fed comes in and stops. And that's basically what happened. I wasn't trading so specifically in 2000, but if you go back and look, what really popped this bubble in 2000 after things got incredibly aggressive on the valuation front was the Fed raised rates in January of 2000, in March of 2000, and then again in May of 2000, as core CPI was reaccelerating. We moved from kind of the low twos at the end of 1999 to 2.5, 2.6 in the middle of 2000, and the Fed had to come in and basically say, we have to tighten. So I think that's how they're going to stop this one. I'm not saying that's what's going to happen, in the next few days, but I think that's ultimately where the rubber hits the road. So they need to come out now and kind of not allow for this bubble to keep going, or they will allow it to keep going, in which case inflation expectations will reaccelerate, gasoline and food will reaccelerate, and then we'll be talking about inflation again, for the U.S. consumer, and that's not something I think the Fed doesn't want to deal with, and nor does the Biden administration really want to be dealing with either. So I guess we'll know a lot tomorrow. I think ultimately, I think that's where the risk asset discussion really hinges on, is whether or not the Fed is gonna come in and really step up and say, we're not tolerating a further loosening of financial conditions that will reignite inflation expectations from here.
All right. So that's a good overview of your model. And Geoffrey, apologies. You used, because I gave it to you, Craig's panelist invite. So it says Craig Shapiro at the bottom, but it's
the people are going to look at that and say, Craig Shapiro.
I'm seeing double.
They're very different Craig Shapiros.
I'm so sorry.
No problem at all.
Okay, so we can't undo that now. We'd have to go back out and come back in. But regardless, people are very, very accommodating. I'm not too worried, right? We're just chatting here. We're coming together for after hours kind of chat. All right, so what's your model of how you kind of look at the market, since we're talking obviously near term macroeconomic data points that can be market moving, but I know you're much big picture, and yet you still trade bonds and precious metals and the like. So, on a shorter duration. So what's your model that you're looking at to kind of view inflation, the Fed, and the year ahead?
Well, I'm going to use a model that is used for fiscal dominance in emerging markets. It's very uncommon to use that, but here's how it works typically. You have a sequence. It starts with a private credit bubble. There are some writings from John Welsh about that. Goes into a private credit bubble first, so you really go into credit problem in 2008. Then it's kicked at the sovereign level, and the losses are more or less socialized. Then you get into a government bond bubble with monetization of some bad debt. And we have done that for quite some time. We pushed the Rubicon after with COVID. Really, that's where it's really went overboard. And then we start into an inflationary bubble. So you got government bond bubble 2020, 2021 that gets into an inflationary bubble. Then we have a duration shock, typical. You look at some cases like long time ago in the 70s in Argentina, before they had tons of debt and then before they went into hyperinflation, or also Brazil. It doesn't have to go into hyperinflation. I'm just saying that you have the sequence private debt bubble kicked up at the sovereign level, monetized. For a long time, it doesn't do anything because it's just moneyed capital, doesn't enter the economy. So it's just a lot of means of circulation, lots of money capital, that goes into markets but doesn't impact prices. And then it goes into transition into an inflationary bubble, and then it starts to get into prices. And typically, you have a war, you have a pandemic, you have both. Oh God. And it starts to get into basically your direction of bonds, which was going down and lower, repressed actually by the central bank. Because the
For 40
bond
years,
price,
you've seen the interest rates repressed for
yeah,
40
the
years.
interest rates were repressed by the central bank until 2020. Not really a deflation fight. This was a false narrative because we had margins, corporate margins were high. And normally that really means you're not in deflation, you're just repressing bonds, you're monetizing some debt. Because if you were in true deflation, corporate bonds would, corporate margins would be low. That would be the Japanese, post big bubble Japan. We didn't have those tiny slim margins, so there was more monetization. But the bond rates going down and the junk bond bubble on oil also repress prices. So people don't realize that we are repressing prices by too much junk bond investment into shale, prices going lower, rates going lower, oil going lower is actually making things look a bit like deflation, because if you're a new producer of commodities, look, oh, okay, oil is cheap and rates are cheap and the new producer has an advantage and price go lower on soft commodities. And then, boom, it reverts. That's where we are. Since 2021, we get into an inflationary bubble. And then we got this fiscal dominance that shows up in several ways. And one of the ways is that when you had the Asian crisis in the 90s, the US authorities used a model saying you guys have to use austerity. After the big credit crunch, they said you gotta have to restructure, you have to do fiscal austerity, you have to do structural reforms, tight monetary policy to anchor inflation expectation, and the over-levered banking system, protect the depositors, wipe off congratulate the bank debtors and tell them who you are now equity holders and well-capitalized, newly well-capitalized bank. No, we monetized. We did exactly the opposite of what the US was advising. EM in the 90s after a big credit crunch monetized a lot, okay? Now the second thing we have, so now we're paying the price. And you cannot stop inflation when it's coming with monetary tools, when it's coming from a fiscal problem. It can be, it has a name in fiscal dominance parlance. It's called heterodox. You get orthodox, heterodox. Heterodox is like, oh, the fiscal side is creating tons of liquidity because deficit is liquidity. It's like whatever spending that is not mopped up by taxes, it's liquidity. When you look at post-Civil War in the US, they did the exact opposite. They did, instead of having deficit, they did, what they did is did a contraction. So basically repay debt. And obviously it's kind of putting the currency like to the rising a lot, very strong currency. Then 1873, they demonetized silver. That was a stupidity worldwide, not just the US. But you have this deflation because you are orthodox. This situation, actually, if the Fed is increasing, you cannot stop inflation with interest rates. Why? Because when you have when you have this condition is that when you have debt service that gets to a certain level, the fiscal deficits rise, then you need monetary finance. So the main driver of money creation becomes fiscal policy, and traditional tools like higher policy rates feed inflation and feed inflation expectation by increasing the debt service cost. And we've seen that in the end of last year. We've seen the rise in interest portion, like 49%. Okay, and so what you end up with is that do you have those interests are actually increasing the debt serving costs. So higher interest, higher policy rates increase the debt service costs and need for monetization instead of starving. So that you're really at a point where I don't know how they can stop inflation. I'm not saying we're going to go hyperinflation. No, I'm not saying that. You get into the well-known scenario. You have currency weak, high inflation, high interest, and it's a typical situation. It's like interest rates rise with inflation and the currency is kind of weak. And if you're in fixed income, long duration, forget that. Please don't do that. Or you can take the opposite side. Equities is a mixed bag. And you have the real assets, agriculture. Real estate doesn't do bad in emerging markets, when you have this continuous liquidity by fiscal. So the Fed is like, and that's why he was kicking and screaming on television. Say, it's not my fault. I can't do it. I think he was trying to get some sort of explaining, saying if the fiscal policy is tying my hands. So that's where we are. So,
question, if I can kind of point this out. I actually tweeted this because I knew we were going to talk about fiscal dominance, and you and I have talked about it a lot. You've shown historically from an economic standpoint that we are there firmly. Right. So I kind of put this out as a placeholder of what it is for those who might not be up to speed on this. Like you said, developed markets don't have a lot of experience with this. This is an EM problem for the most part. And Craig has been on this for a year and a half, basically saying we're turning into this. And you actually said he's right. And when we first met on Twitter, a year and a half ago. Yeah. So this is it. Political pressure to use the central bank to accommodate government deficit spending. In a nutshell, is kind of the definition of fiscal dominance, correct? Any clarification you'd put on that?
Yes. In other words, the clarification is that the monetary creation depends more on fiscal spending than on credit, private credit. That's the source of flows of money.
Okay. But as the deficit swells, what's the plan to repay it? Pretty much you're saying there isn't one.
At this point, there's no fiscal plan. And that's what is a problem for term premium also, because if you have a situation which is not great, but you have a fiscal plan, say we're going to do this and we're going to do that, then the bond markets start to go, okay, let's give them some slack. It's going to take some time, but they have a plan and they're following the plan. There's no fiscal plan. So term premium here, you have a big risk.
Okay. So would you kind of agree with Fred Dorn, Cato Institute? He writes about fiscal dominance. Inflation is a way to default on government debt little by little.
Yeah. But if it's planned, and if people say, oh, we're going to do a bit of restructuring this and restructuring that, then the bond market goes, okay, all right, they're going to use a bit of inflation, but they also do some restructuring. They are doing a package and there is a direction. Then the term premium is not pushing even more, because once the term premium is, what the hell are you doing, guys? That's the risk. There's no policy on fiscal. Then the bond rates go boom. And that makes inflation actually worse because it's ingrained inflation expectation. It pushes costs. It needs more monetization. Interest rise in the budget, and you need to monetize more interest.
So when is it really going to be front and center a problem? In other words, when is fiscal dominance and swelling deficits a problem? I have a great quote here again by Fred Dorn, which is the real problem for the Fed will be if market interest rates begin to rise capitalized with by me and for emphasis, with the economic recovery and banks start lending out their excess reserves. Right now, they're not lending out their excess reserves. What would trigger that event?
I think the typical situation for bond markets is when the long end goes trust,
What do you mean?
Liz Truss. You remember Liz Truss?
Oh, Liz Trust. Okay.
Yeah.
Yes.
Yeah. What happens is that the bond market goes Brazilian. It goes on the long end. It starts to get steep for the wrong reason because people say, forget about those bonds. They don't have a policy. I don't want to hold that stuff. And it can happen with any size of market. It's just the market is bigger than the policymakers. So they're playing with fires and they say, oh, we're going to change the maturity, and they're dancing around the problem. And that's why Diamond said, Diamond, Jamie Diamond. Yeah,
yep.
sorry.
JP Morgan.
It said the US crisis is the easiest, is the most telegraphed in history. It's the most predictable. At some point, the bond market, when they say enough, it says enough, and the yield jump. And then, okay, they're going to do something. And then they are doing a meeting, some sort of emergency meeting, and then they come up with a plan. And then the bond market stops freaking out.
Okay, so then we need to kind of segue to, we're not there yet. We don't really have this trigger for money circulation to, from banks lending out their excess reserves, where bonds would basically go Brazilian. What is the trigger then for real GDP growth in both of your estimations? How are we going to get there? For example, productivity was a big feature of Waller's recent speech, and I know, Craig, you follow him closely. What's going to kind of get us going in real GDP?
I just put it in the webinar chat. There was a paper by the Fed, Charles Calamareisis. I put his paper in the chat, and he talked about fiscal dominance, and he talked about this idea that basically everything that Geoffrey's talking about here, but that you don't know exactly when that point is going to be where the long end of the bond market just says no mas, right? You don't have a great idea. Hold on, someone said they can't see the link, but
gotta hit to everyone.
Okay, hold on.
Probably
sorry. Yeah. Let me do it again. But so you don't ever really know the exact point in time, but you also don't want to really ever get to that point in time where it happens. And so, but one thing he pointed out, and this gets into kind of some criticism I have about the Fed, is he talks about this idea that at a 2% real rate of interest, if sustained, would be something that effectively bankrupts the U.S. government, right? It's a level of real interest that the government could not pay for, and so we could not exist at that, given our borrowings, given our deficits, given the debt to GDP ratios, that we would be clearly in fiscal dominance and would need to start reacting to it. And so what I think has been going on is I think the Fed has reacted to the move in real rates in August, September, and October, where real rates moved above 2%. And that is the reason why they pivoted. And they have become more myopically focused on this real rates normalization argument because, the Overton window has moved. Everybody knows the government is bankrupt and that the Fed is the entity that will, can help them, is the only entity that can help them out, because the only line in the government's budget that can actually materially move down again at any time soon would be the interest line, right? It's the only line that could move. Obviously other spending should be able to move if we had a functional Congress, which we don't. Revenue tax receipts theory should move, but and maybe they will move if we bubble up, because then corporate then capital gains taxes will help. But really, that the Fed myopically looked at real rates because they know the government couldn't afford above 2%. That's why they pivoted. And what they either did or didn't realize, and I'm not exactly sure yet, is that because the corporate and household sector had been tied into such a low rate of borrowing post-COVID already, that everyone is sort of, flush with cash. And no one really was affected by the move up in interest rates from 0 to 5%. Not nobody, but not enough to slow things down. And so by loosening or suggesting that they were going to be cutting rates this year, financial conditions have just loosened so materially to a point where now they are, according to the Goldman Index, and to now the Fed has 3 indexes that they've told us to look at. They're basically all now looser than they've been in quite some time, two of the indexes are looser than they were when we started the tightening cycle. So financial conditions are incredibly loose, but the Fed is focused on real rate normalization. And the only logical explanation could be that we're in fiscal dominance because there would be no other reason for them to act the way that they have. So look, I mean, from where do we go from here? It's not entirely clear because I feel like Powell and this Fed, they'll never come out and say we're in fiscal dominance, right? No one will ever really ask them appropriate questions to put them, on tape to help them understand. But it seems pretty clear to me that's what we're doing. So then the question from here is, well, how does the Fed now react to a reacceleration of inflation expectations and a reacceleration of inflation in the coming weeks and months and quarters? And that's some cyclical stuff. That's structural with deglobalization, with a tight labor market, with demographics. And, it may not be the case that we return back to a 6 to 10% inflationary environment, but the Fed's target is 2. So 3 to 4 to 5% is not tolerable, according to them, right? I mean, they may ultimately decide that they're going to change the target, but they've been pretty adamant that is not the path that they're
under Powell's watch for sure.
Yeah,
and I apologize, it wasn't Waller who had the comment on productivity, but I bring that up as a kind of fuel for this GDP growth. It was Goolsbee who said nothing is more important than the productivity growth rate.
Yeah.
So, and for me, I'm kind of unpacking this. If productivity growth offsets the wage growth, which is that worry, right? Wage growth, wage price spiral and all of that, which is very much a trigger for higher inflation. They're not worried about that. As long as productivity growth offsets or outpaces wage inflation growth, then the Fed has less fear higher wages can stoke inflation. In other words, no wage spiral. So they can get a lot done or push out in time, some of the damage that could have been created had we not had this AI FOMO. Seriously, I think it's very, very well timed, isn't it? It literally came in of May of last year. Now everyone is completely sentiment-driven generative AI as the 1995 replacement for the internet as a productivity gain. So productivity gains from literally AI versus labor. Salaries and workers. Any comments on that? Because I thought it was actually pretty interesting.
Look, I mean, I think that the last 2 quarters of productivity data have been better than expected and above trend. So while the Fed has, I don't think the Fed necessarily has embraced yet this productivity boom, but the market has. Right, the market is saying this is a productivity boom. This is the mid 90s. And inflation can return to 2%, and the Fed will be cutting, and everything is fine. And I just think that these productivity trends take a long time to play out, and it's just not clear to me that AI, which is basically a year, 18 months old, has had any impact on productivity yet. So I think it's just way too early to jump to those conclusions. And the only way that the market will be kind of told it's incorrect about assuming productivity is there is when is data points like what we got from core services ex housing inflation going up 85 basis points month over month in January, and core PCE, if it were to reaccelerate as I expect it will, that's how people will realize it, right? It's not something that you can measure and identify like in real time. It's a derived calculation. So I think, we need to see the inflation data. If it moves higher, it's suggestive that productivity is not as robust as maybe the bulls and Goolsbee think. But if it continues to fall, then yes, I think that would be, more evidence that this is really something, and that workers will, not be able to kind of extract outsized rents from corporates, and they'll be able to keep their margins, and maybe prices, they don't need to take prices up materially, from here. And that will be your mid 90s kind of nirvana stage. To me, it seems early to make that conclusion, but
it is early.
But I think the market is increasingly making that determination.
So I have to, and I know, Geoffrey, I haven't given you a moment here to respond to all that see, I did it. I called you the twin brother here, that Craig just kind of went through, but any comments on productivity and its impact?
All right. So productivity this time needs to be higher than in the 90s, because what we have is that you have two forces. You have a force which is inflationary and a force which is productivity driven deflationary. The force which is, and those two offset. The problem we have right now is the force that is inflationary, which is fiscal spending, did not exist in the 90s.
Very good point.
So the people say, oh yeah, we have, no, we need more productivity. It can happen, really have a super high productivity, higher than previous periods, then the government will be bailed out by that, not the Fed, because it's not the Fed's fault. The problem I see is that historically, when you have wars, you have rates which go up, and war spending is very inflationary. It has a very low multiple. In other words, if you take 10 billion, or I don't know, $50 billion, and you blow a big hole spending $50 billion of just blowing some weapons. Now, you can take those 50 billions, and then half of it, you make a big hole in a mountain, and the second half, you build a dam. With the dam, you generate electricity that can be used for, I don't know, aluminum smelting or other production of goods and services. You have a multiple. You have spending that generates a multiple. So this type of spending, which is entitlements in the war, have very low multiples. If one way to restructure is say, hey, and that's another problem. If you so the productivity has to fight a higher level of inflationary forces than previous cycle. That's why I'm saying maybe it will happen, but
it has a high bar.
It has to be pretty good. Okay.
It has a high bar. So then what's your view of interest rates? Taking the 10-year, largest market, 10-year yield, US, largest market, bond market is everything is based on that.
I was talking to John Welsh, who's been doing, is a specialist of fiscal dominance. I was talking to him, say, bonds have been below 4% since March.
They're not that efficient.
They're not efficient. It has to be much higher.
Okay. So what's the lowest part? Even if we were to hit a recession, where would we land? We're not going back down to zero.
Sales are down. The retail sales, the numbers are down, and we have rates at, inflation has been real accelerating with sales down. The PMI industrial is not being, I know in these situations of fiscal dominance, you have to know that all governments around the world are going to try to, as much as possible, make sure that people don't have crazy ideas that the inflation is going to rise a lot.
Yeah, Japan announced they're in recession technically. UK also today, in recession technically. So whatever repression of yields, but where do you think the bottom is for the 10-year? Will we see 2.5% again in the next few years?
No, I think we already have seen the bottom.
Craig, what do you think is the bottom for the 10-year for the next few years? 1 or 2. I'm not like 10.
Yeah, look, I think the bottom. The bottom in 10-year yields is going to come when the equity market bubble pops, right? So there's going to be some natural, out of equities into bonds, safe haven, something for a period of time while the market says this is the deflationary bust and that's coming. And then but at the point in time when then they realize that the Fed and Treasury will really not allow that to go on for very long, because that will be the bottom. So I don't know, I think we can maybe get down to a low 3% 10-year in that environment for a day, a week, 2 weeks, but that will be the greatest opportunity to sell bonds and sell 10-year that we've ever seen, right? I think we're going to carve out a brand new range, from low 3s to high 5s, and just kind of grinding and moving higher over time, until and unless the U.S. government figures out a way to increase taxes, lower spending, and get its house in order, or enforces more financial repression by making banks hold bonds, and more regulation that incentivizes pensions to hold more bonds. more treasuries, things like that. There's obviously always a chance for more regulation to force buyers into the treasury market. And typically that happens when things get a little bit crazy. So yeah, I think that will slow down any pace of yield spike, right? But I think over time, the long end is kind of screwed.
Any other questions on that, Geoffrey, before I go to the next question?
Well, I just on this bond side, I think that the market is more and more understanding that we're not in the credit freeze. If you remember, we had March 2023. We bottom at 330. The yield went to a bottom of 330, and it was a duration shock. It was not a credit freeze. So it was a fiscal dominance thing, actually. It's a duration shock. It's a duration. It's not really the private credit that created the problem. And then we had another one, which is NYCB bank problems. For me, it's the benchmark because the equity market, if people think the equity market will plunge, they plunge because there are credit issues. And I remember MCI, WorldCom, there were bankruptcies in 2002, the credit spread was going up because there were a bit of junk not going so well. And then what you saw is long bond properly moving up, okay, and equity in squeeze of liquidity. Here, the government is just pumping more and more liquidity with the deficit. If you want to have a deflation shock, it would have to be the government going cold turkey. And there's a chart that we will share, is that fiscal dominance price go up, the default price go down on default. That's what happens. So for me, I don't see how much, if we have another bank going down and okay, 10, 20 basis points, you short the bonds again. But if you think about it, 2003, the 10 years bottom at 310. And there was not a whiff of fiscal dominance. So we bottomed 330 with SVB and the regional banks in March 2023. Then we have a 380. I said, 380, let's short more bonds. I do not, with sales, which is the biggest element of the US economy, down, and the market looks at inflation and says, oh, imports and exports up. I mean, it's pretty significant. We didn't have so crazy PMI for the last year. We have sales, retail sales down. We had I know the government says we are booming, but retail, I mean, I tend to think that I'm not expecting a lot. I think that for me, and when I talk to John, we were thinking the bond market needs to be much higher in yield.
Okay. So that brings into play, and I definitely want to go through the questions that have popped up, but I just have a few other things for these gentlemen to kind of frame their thinking, because this is the model that they use to view the market. And then obviously actively manage their investments. So both of you used to run funds, portfolio manager, hedge fund manager, and now you're managing your own money. In this particular backdrop where you have some very justified, fundamental or macro concerns, and yet that this asset appreciation in stocks can be sweet for active traders, right? So I see a lot of bullish setups, right? And this, whether it's 1995 and it's just getting started, or it's 1999 and it's almost ending, I don't know, but it's very bullish from my perspective. Since about mid-November, it just got this feel of 1999, and now I'm like, maybe it's more than that. Maybe it's actually going to go a little bit longer. So I have, I've got my bullish backdrop from a tactical standpoint. But for both of you, how do you kind of reconcile that it's bullish? It's so bullish, it's bearish. And like you said, with the dollar, it's going to be a little soggy. It's not really going to have, if anything, it's going to support these higher asset valuations, real estate, and potentially stocks. So do either of you like equities right now, or are you kind of worried that this is going to turn sooner rather than later?
Yeah, I mean, for me, like I've been, negative on equities, and felt like, this window that we're about to get in right here from February to March would be the kind of highest probability opportunity for markets to top out. I've been playing, I do use very short dated, NASDAQ calls to kind of keep me in my trades. And I've been targeting kind of the March expiry, for bearish expression. I think we talked about this, I think, last time, but I had put it together kind of what I thought was a framework for, how does the bubble pop? And I think that, the markets are self-correcting in a way that as animal spirits come back in and the wealth effect is rising, people are making a lot of money trading and equities are going, to the moon. It does filter into the real economy, leads to better growth. It could lead to higher inflation expectations, which then ultimately should lead the Fed to change policy. And that acts as the kind of taking the punch bowl away, for lack of a better word. So I think that where we are now is it wasn't clear to me that I knew we were going to see this reacceleration of inflation. Mm-hmm. I didn't know if it was going to show up as mightily as I think it did in January, or if it was going to come up in February, which would be March, but I knew it was going to come. And I do feel like the data that we got this week suggests that it's here. Every inflation data point that we've been getting for the last, several weeks now has been hotter than the last. I mean, these regional PMI surveys, the services prices paid, the CPI, we'll see about the PPI tomorrow. So it doesn't look to me like the near-term momentum on inflation, on disinflation is getting better. It seems like it's getting worse and inflation is moving back higher, which should argue against the Fed bringing in these cuts. And part of their real rate cut normalization mantra, is the Taylor rule. And the Taylor rule, it is impacted by higher growth. If growth is going to be higher, like it has been, it's becomes more difficult for them to achieve that last mile of inflation. So it kind of justifies less rate cuts. So I think as we price out the rate, I think we really did see this week something very interesting, right? I mean, when the data came out on Tuesday of a hotter than expected CPI print, the market acted as if exactly as I would have thought, right? Vol got bid, the dollar rallied, yields went up, and stocks got smacked hard. Now, then you'll say, well, what has happened in the last 24, 48 hours is we've retraced a lot of that equity move. And I'd say, well, it's expiry week, right? I mean, it's very important. Expiry still is the biggest driver
option flows, indeed.
Of S&P. And so I think what we saw today, just specifically on Russell versus S&P, is that the S&P does seem relatively pinned here up at 50-50 or 50-25 or S&P 500, at a SPY 500. And so as NASDAQ names start to come under a little bit of pressure and, dealers have to hedge less, there's some selling there, but the S&P is pinned. So you need more Russell gain in order to keep the index pinned at 500. I think on the other side of tomorrow and into next week, we'll unleash, more kind of natural trading where expiry is less of a factor and these buyback flows are not there. But I do think it's interesting that the VIX is above the level from 8:30 on Tuesday. The dollar is stronger than 8:30 on Tuesday. Yields are all higher than 8:30 on Tuesday, right? The rest of the market has not traded, a Fed that is going to be cutting. The rest of the market is basically saying that inflation print worried us, and if that continues, this is going to be a problem. So I think if that's the data that we get tomorrow and into next week, I think that's we're going to have a continuation of a risk off event. On the flip side, and I'm very cognizant of this, a very weak number tomorrow where they say core PCE has been, they'll bring back in the March cuts and the market will scream higher again. But we will have this reacceleration of inflation expectation, break-even yields moving higher, and at some point the Fed is going to have to step in. So I think that the data tomorrow is enough for them to step in. I could be wrong, but by the March meeting, if we're up at 5,500 or so and oil is 90, I think definitively they will step in, and we'll be talking about no hikes this year as opposed to 3.
All right. So I have my bullish backdrop I want to share, and then we'll go to Geoffrey, because I know I asked you the question, but I'm cutting in here because we're talking short duration stuff that's going on right now. And I know for the most part, I assume, Geoffrey, you're talking a little bit, longer dated. So let me just jump in here real quick. As it relates to these flows, they are massive as it relates to underlying bullish option flow. There's nothing else to say about that. But we do have some other reasons that this can go higher. And I just want to get your feedback on this debate. First and foremost, and this I had just done in a response actually to someone on Twitter who was like, what's this 1995 business? And so we're not 1995 in fiscal dominance like Geoffrey has mentioned, but we absolutely have funds deploying capital. There's a lot of money, whether it's the 2 trillion in VC that could come in and start doing a lot of IPOs like they did in 1995. Again, this is rhyming, not a fractal with 1995 exactly. We also have a lot of money that is still betting in a concentration risk fashion on this, MAG 4, 5, 6, 7, however, depending on the day. So, and they're still betting on rate cuts that lowers that whole cost of funding. So there's the narrative, and then there's the chart setups, and then there's the option flow. We're talking, I know, a little bit different thing here with a backdrop of debating how strong productivity could be and fiscal dominance is to the case, but they are absolutely, from what I can see, jumping all over equities because they can, and falling, like you said, the easing conditions, falling low inflation, it's a thing. We could be range bound for a little bit. Wage growth is absolutely helping consumers to absorb higher prices, and they keep spending, even though retail sales was down, I know, and PMI is not winning any awards. We definitely have delayed recession. Productivity gains, we've already kind of covered. Corporate earnings, they actually think we just troughed in Q4, right? They've got these expectations for the next 6 quarters that only go up and to the right. So there's that narrative. Not that I'm behind. I'm saying like these are the reasons the market right now is painting a very bullish picture, long story short. So we have asset prices moving higher. We have AI as the hot, theme du jour, just like the internet was back in 1995. And obviously after that parabola broke in 2000, which was obviously a very tech-centered breakdown, it was a lot of trapped longs. And they triggered volatility and liquidity event is always what happens from a parabola. We're not actually in a parabola. There are some charts that are, absolutely. But the market overall is not in a parabola. We could get there. Anyway, we got that FOMO just like we did back then. Rising fiscal spending. Everybody is on this. Yellen swears by it, that this is going to be offset by economic growth. And that's a big area where I know both of you have debated hotly that that's really suspect. We have definitely controlled, and contained energy costs. They could percolate higher. Right now, that's a risk. But for right now in an election year, no bloody way are they going to let oil prices rise. So it has been a way to temper inflation expectation. This is all the bullish stuff I'm coming up with. You can pick it apart after, but I want to just get through real quick. De-dollarization. This is something that Geoffrey has really done an excellent job educating about, that it's okay for more local currency exchange outside of the US dollar. I know it's, a hot debate, and Bitcoiners are all excited about debasement, but the point is this de-dollarization actually, as explained by Geoffrey, can help lower the trade deficit, which leads to government deficit shrinkage. So there, as I'm looking for the bullish case, remember, I'm working hard to come up with this list, okay? So we also have financialized engineering. You know what they are, whether it's the buybacks, which are ginormous, or the round tripping, which right now is finally making it mainstream on the NVIDIAs and the like. These are seen as features, not bugs. They're seen as bullish backdrop. Why would you want to short this? We definitely have all that optionality, which is drama filled, but also it's working, right? They're selling puts in the index and buying calls in the Mag 7, or they're just zero DTE, gamma squeezing, and they're masterful at the market makers getting this to move higher and volatility control to stay with suppressed VIX. It's masterful. There's no question about it. And then, of course, hey, White House, Treasury, Fed, they absolutely coordinate, and globally at times, with central banks to make sure the market doesn't blow up. So we have that quintessential Fed put, the Yellen Yahtzee of issuing more T-bills than bonds, which is in that quarterly funding announcement that we had in November 1st. So we have a lot of reasons that it to me, is very, very hard to short this market. I don't think it's fun at all. So whether this is 1995 and we've got some really nice laggards that are going to play catch up and some, all this bullish backdrop, or it's 1999, really no. But I definitely don't think it's a safe time to execute big picture shorts, even though, and you both have done such a great job of this, we have a deficit, I should say, deficit to GDP is 8% and growing. And we have fiscal dominance, which is keeping all of this, asset appreciation firmly, in play. All right. I got through that. My top 10 list. Take it away. Comments. Push back.
Go ahead, Geoffrey.
Jeffrey.
Okay. From a liquidity standpoint, I love how Ray Dalio said recently, if you see things moving up, be careful. It might be just the currency. I would just give a big picture, give you a big view. We're about the same level on the NASDAQ as we were in November 2021, right?
Absolutely. A little above, but yeah.
It buys
NYSE
you
as well.
20% less food. Okay. So what you're saying is like, referential, because food has the same utility. I'm looking at that from the classical economic standpoint. A basket of soft commodities, not just one, a basket of soft commodities has the same nutritive value back in November 2021 as today. So you have to wonder, your return in money is not the same as return in kind. So I would say we're not really in 1995 with a small sliver of monetary base and credit expansion. We are with a huge pile of monetary base, and we are going, it looks to me more like we're going 72, 73 late of this period into some sludge of fiscal dominance. That's my first point. My second point would be...
You say 1973 and then into sludge, fiscal sludge?
We're going into this mud where things don't really move. And actually, Draco Miller said that I could see the stock market do nothing for 10 years.
10 years, yeah.
Yeah, sideways, while the multiples slowly shrink. But since the earnings increase, then one offset the other, and the yield keep creeping up with inflation as long as nothing is done on the other point is, let's assume the government had once didn't spend 7.8% deficit. How would be the economy Can't answer
that. Don't have an answer for that. But this is a good question this is a good question though too. Archon is asking, one analyst thinks that the dollar will rise after the election. We don't even know who will be the president. And we have also, I have to put this in here because I thought it was a fascinating article. Pippi Malmgren wrote 2 articles, not just one, but 2, on how RFK as an independent could actually upset, for the first time ever, the presidential election. And she was one who predicted Trump back in 2015. So I'm very
that'd be a very interesting scenario for the US dollar. Because that'd be difficult to be very bearish at that point, because it seems that some spending would be, spending that is not productive. If you put the spending to put roads, trains, more infrastructure, you do the same spending that has low multiple, you do that in domestic, you have multiple, you have productivity, that'd be very bullish. But
bullish the dollar and equities? Or
I think it would be bullish the economy. And I don't see how the stock market would be feeling bad about that. But I agree with you, shorting in fiscal dominance, only the bonds and long duration stuff. Another point I want to make very quickly.
Go ahead.
There has been misallocation of resources for a long period of time in the US. And it's very visible with the rising. We went from 20%, we rose to 40% of Russell have negative earnings. We in the 90s, we had 15. And how is it possible? Well, you cheap money, new biotech, let's fund this, let's fund that. The probability, not now, I think that I totally agree with you on the short term. It's hard to see that in the short term, except if the bond market goes crazy. But you have also the other scenario where this fiscal dominance is higher rates and inflation progressively, and that's the mud scenario where you get into. But short term, I wouldn't, I think I agree with with you. But the other point is market cap to GDP is high. It's very high. Multiples on many companies are not low. And you have this Russell pile of cheap money getting into non-profitable companies. You're going to have a cleanup. Is it going to be now next 6 months? I don't think so. But you're going to have this cheap money 10, 15 years and this high market cap to GDP. It has to, at some point, be corrected.
Yeah.
It
has to, what was the last word I didn't mean to interrupt. It has to what?
It has to correct at some point.
At some point. But there's still $3 trillion in money supply sloshing.
I'm not saying the short term. I would not disagree.
Okay. Another question. Asking about China. Now, these are short term. By the way, if you're a client of LaDuc Trading, Geoffrey has done so much work on BABA and China equities. So that's all I'm going to say about that. You've got to see his research. It is so good. And there's a lot of fundamental as well as macro. He knows China. That's his focus on that education. But in a nutshell, I'm still waiting. Personally, I've right now it's doing fine. It's in sideways mode. I'm not
it's kind of testing the bottom right now. It's testing this bottom.
And then sorry. And then as some of the Q&A, is Fed holding rates as a political plot? Last time we did a roundup for Edge clients, Craig, you referenced an article. I think it was Stephen Mirren.
Yeah.
Basically said Yellen is being very political. It was an excellent article. And then you mentioned the other one that you also put into chat. Do you want to kind of summarize that as far as the...
Yeah, look, I mean, the Fed likes to say that, they're not a political organization, but they clearly, each of them independently has biases about, their own affiliations and party affiliations and who they may or may not like to see lead the country next. And so look, I think there is some politicking that goes on inside the Fed, but I don't know. I mean, I think I don't necessarily think that the Fed believes it's going to be starting an easing cycle this year because, it wants Biden to win or it doesn't want Trump to be the president or anything like that. I think it ultimately they are doing it because they believe that inflation is falling. And so they want to have real rates come down. And as far as the timing of the beginning of that cutting cycle is concerned, look, the Fed has raised and lowered interest rates in election years, before countless times. And so, I don't see the election specifically as an impediment to the Fed acting. I do think that Yellen is more political and she's a Democratic appointee. And so she can act in a way to try to support assets or support the economy through bills and bonds issuance. But even on that front, she's already announced basically, kind of what she is thinking for the second quarter, which was an increase in bonds duration supply. And that's likely to be the same thing that happens in the third quarter. She'll keep that level constant. So, she could run down the TGA a little bit, but even on that point, it would be seen as highly political. So it's not clear that she really can move the lever on the market too much. I don't think between now and the election without being seen as like super political, where Congress came in and was like, what the heck, what are you doing? This is clearly, for political. And so, I mean, I think the last point would just be on quantitative tightening, tapering of quantitative tightening. I mean, the Fed has basically now said that they will discuss it at this meeting that's coming up. And I suspect that there will be nothing decided and there'll be nothing in the statement about it. And Powell will be asked on the Q&A about it. And he'll maybe give some sort of framework about, that they may begin tapering later this year. But I don't think that we're going to be, in a position where tapering happens in the second quarter. So they'll but because they've talked about this ample reserves regime, and I think with the markets doing what they're doing, there's not any real suggestion that bank reserves are not ample, right? I mean, the RRP has been drawn down, but bank reserves now are back above $3.5 trillion, and they're significantly higher than they were in 2019, and they're significantly higher than the 10 to 11% of GDP target that the Fed has said is appropriate. So I think that we're going to continue to see CQT. So conspiracy theories, I'm all about them, but I'm not sure that's the driver here of how the Fed and how Treasury are acting. I do think that they just want to see that inflation come down, and they're not going to see it, and so they really should be. Now, politically, maybe this will make them not raise rates this year, right? I mean, if I were to say, I think they should be raising rate. Like, let's not forget, in September of last year, they said they were going to be raising one more time in 2023. Well, they forgot to do that, right? And so, and they were talking about 2 rate cuts for this year. Now they're up to 3. I mean, so they've eased. Why are they not raising rates? Maybe politically they may feel like they can't raise rates when maybe they should if inflation's reaccelerating. But then we get into the point about what Geoffrey was talking about. Raising rates actually can become even more inflationary. So,
as the economic backdrop is holding in and the labor market is tight, as yields rise, the narrative is now changing to that is healthy for stocks. They used to be inversely related, but since December and January, they have been doing a little bit different dance. So they're kind of playing on that. Geoffrey, just the last few minutes so we can kind of close up. I know we're past the hour, but we're covering so much and there's 3 of us. What about the bank reserves and some comments on banks? Because I know that you have studied this very closely as well.
Right. So the FDIC report says that we have contraction in commercial and industrial, and we have a bit more delinquency in credit cards. Okay. So you have a bit of pinch there. We had duration shock, and we had duration shock in October 2022. We had duration shock in September. Each time, the market doesn't like it. If the bond market stays quiet, I think the equity market can keep rising. If the bond market says, nah, I want more yield, it's going to be a headwind.
The money market funds, if they want more yield?
No, the bond market, the long bond.
The long bond, they want more yield. Okay.
Remember, we had long bond, the first jump in long bond that made the DXY go 112. Then we had another one in September last year.
When we hit 5% 10-year, that was a long
and then we go
premium.
and then instead, and actually we go higher in yield, but the DXY peaks at a lower level. Okay, so everyone say, and I think this is the story we're gonna see is like the bond yield for some time, and the equity market stop and go doing a bit of tango. Okay. But if the bond market stay quiet, I would say, equity go.
And you're not worried about banks?
Banks, yes. I mean, banks, you have a bit of CRE exposure. So what you have, if the bond market goes too high, you're gonna have there's an interesting play, hedge fund play. I want to do a report and try to find out what's the best asset to do that. If we do have a inflation, the correlation between the treasuries and credit, instead of being inverted, is positively correlated. In other words, if you really have what Diamond says, it's gonna come, guys. It might not come today. So I'm the sad guy here. I'm playing the role of the party crasher. Sorry about that. But if we have this jack up in bonds from the bond market, from the bond investors, then yield go up, and the guys which are 40% in the not making money Russell, credit doesn't do well, and then you have an opposite correlation. So you could have probably finance calls and put out of the money call. I don't know. I was thinking the first trade, say you have a bond fund because they have credit and they have treasury exposure, and they say, but if credit goes bad, our treasury will go well. Okay, so they say, hey, this is one offset the other. In a fiscal dominance, it doesn't work like that. The rates go up on the government debt, and credit goes bad as well. And what you can do is you could self-finance. If you find a bond fund that you have derivative.
We'll save this for clients.
Yeah.
All right. Well, we'll get into the weeds with that. Thank you both for kind of showing the model that you use, your market perspective, expertise also on this this crazy backdrop of a very, very, I think, interesting. I love it anyway. I love this riddle, and the narrative is not stuck. It keeps changing. So it is very much like, riding so far a gentle roller coaster. Any final words on upcoming kind of macro event risk, Craig, or any, things that you're looking for, Geoffrey, that are really very bearish? Otherwise, I still see a bullish backdrop. I can't unsee it. I need a macro trigger. So let's talk macro triggers and close it out.
Yeah, look, I mean, I think I think we're in a, 1 to 2 week, I know it's kind of very short-minded, but we've been kind of targeting period for a while now. There's a 1 to 2 week period here, I think, where the market is, I think, particularly vulnerable to a correction that would be driven by higher than expected inflation data that priced out interest rate cuts, maybe commensurate with, this blow off top that's going to happen in NVIDIA next week. And so just given the, call skew and how expensive it's gotten and the like. So tomorrow's PPI is important because it filters into core PCE. Next week is NVIDIA's Wednesday after the close, and the Fed minutes are also Wednesday. So we'll get some, more color about whether or not, what the Fed is actually thinking. And then, there'll be a dozen Fed speakers next week, and the following week you'll get the PCE. You'll get some more data. So I think, I think if it doesn't happen, right, if we don't get that narrative, then we'll bat into that window again where the buybacks of the March expiry are enormous, and we'll probably, make new highs, into the March expiry. But then we'll have to look at how's inflation doing and how are these inflation expectations looking, and maybe try, we'll probably try it again, because I don't think, I think at this point for me it's hard to see. I know you've been talking about the IWM possibly breaking out. I feel like it's hard to see a bullish rotation out of tech into small cap when a third of the index has negative earnings, and that the year-on-year earnings growth was negative 30% in the fourth quarter, right? It's just I get what I'm seeing in the charts, and I could still kind of explain it by the flows dynamics, and so but we'll see. I mean, we'll have to. I don't see it as a sustainable trend yet. I think it's more likely to work, on the tail end of a cutting cycle rather than before a cutting cycle.
You've definitely mentioned that before. You really like it on the tail end of a cutting cycle. We haven't even gotten into one. And normative cuts you don't think are on the table for May, June, not even July. So you're on record. Yeah. All right. Just any other dates of importance? I know we have non-farm payrolls. We actually have 2 NFP and 2 CPIs before that March FOMC, but we're not expecting anything to change. What about the Super Tuesday, which is coming up for the primaries? Maybe that's market moving. And of course, the next productivity report, which I kind of just highlighted earlier, that Goolsby is very focused on, is on March 7th. All right, so those are some upcoming events. Any final words of macro event that or I should say macro triggers that you're looking for, Geoffrey?
Well, I was looking at the data from China, and it's not because I look at a lot of this market because there are a lot of valuations which are cheap. I noticed that even Hugh Henry was not so negative because they shifted a massive amount of credit creation to cars. Consumption is not doing bad. I frankly doubt the growth was not bad last year. The market is another situation, but the fundamentals I don't think they are just that bad at all. I see productivity, working very hard on these electric cars. Doing a report because it's going to change things in oil demand very quickly. We're going to have to do a report on that because in less than 24 months, the largest market of cars in the world would have explosion engine minority. And we are going to have to discuss if we are going to be petrodollar or EVUN. You know what I'm saying? Because they export a lot of that. So, that's the thing I'm looking at.
Okay, so we'll also, just in closing, we want to do this with in a few weeks where the focus is on Bitcoin, which we have not talked about. It's a bigger discussion. We covered a lot and we went way over. And I thank both of you gentlemen for coming in and covering all these questions that we had, and for participants. So thank you very much for attending Macro to Micro Power Hour. Geoffrey, pronounce your last name, because even though mine is LaDuc, I don't speak French, and it's I don't want to muck it up.
Fouvry.
Fouvry and Craig
Fouvry.
Shapiro. So
LaDuc.
it's not Craig twice. It's yes. Anyway, okay. Have a great rest of your week, and we'll come back here in 2 weeks, huh?
All right.
Okay.
All
Bye-bye
right.
now.
Bye-bye.
Thank you. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.